Welcome to the Skillick Explains video, and welcome to a quick conversation about what to do if the stock market takes one of its periodic dips. Now, I record videos on this topic quite often, but it seems at the moment quite a few people are nervous. We've got global supply chain issues around microchips, to name but one, not to mention energy, of course. We have central banks mulling, raising interest rates, reining in quantitative easing in order to see off inflation. We've got tax rises in places such as the UK as governments try to claw back the cost of the pandemic. And we've got people wondering whether the rate of economic growth we've seen post-pandemic can be maintained and what implications that might have for the stock market. So, plenty of reasons to be nervous, but that doesn't necessarily translate into any kind of stock market movement in either direction. Remember, stock markets are always looking ahead, they're pricing in the future, and they often choose to see beyond immediate short-term trouble. But nonetheless, a lot of people want to know, well, what do I do just in case we do get a stock market correction? And I'd say there are 5 things, and I'm going to agree with a very seasoned commentator called Tom Stevenson on some of these 5 ways just to get yourself psychologically prepared for any dip in stock prices. Number 1 is hold enough cash. Now, the problem with cash is it costs you money every day. At the time I was making this video, October 2021, inflation, according to which measure you look at, was running at around 4%. The best cash deposit rate I could find was just over 1%. So you are losing around 3%, and that's before considering things like tax, for example. You're losing at least 3% just by staying in cash. But nonetheless, cash gives us comfort, and there's a practical reason to hold some cash. Emergencies is one, the rainy day fund I've talked about many times, and those foreseeable calls on capital, imminent cash requirements coming up in the next 5 years. You don't want to be overly riskily invested once those start to materialize. Beyond that, by all means, hold a little more cash at the moment if that makes you feel comfortable. Quite a few fund managers are doing precisely that right now. And some investors will want to do the same, with the caveat you don't want to be sitting on too much cash for too long. Number 2 is to trim any holdings that have got out of whack. Now, what I mean by that is do regular rebalancing, and this is something we should all be doing systematically. But it's basically looking across a portfolio of, say, 30 shares that is normally roughly evenly weighted, and just looking at whether any positions have grown to the point where they're skewing the portfolio and they're skewing the focus of the portfolio. By trimming those holdings and reinvesting the proceeds elsewhere, you will basically level up, to borrow a phrase that Boris Johnson's keen on, the overall exposure. Number 3 is check diversification. I just want to say something about this in the context of equity portfolios. It's important to make sure you are diversified by theme, by sector, by geography, and also make sure that if you're running a growth portfolio, and many long-term investors choose to do that for what I hope are obvious reasons, you're diversified within it into defensive, cyclical, fast growth style companies. Not all growth is created equal, not all growth stocks the same. So there are various ways you can diversify a portfolio to give yourself some sleeping well at night comfort, if you like, with the caveat that diversification won't protect you if the whole market drops, but it will limit the damage compared to somebody who is very concentrated in just a handful of securities. Then there's debt. Now, I don't know what the Bank of England will do next. Chances are we may have some rate rises on the cards at some point. Monetary policy may go into reverse in the form of quantitative easing becoming quantitative tightening, something I cover in other videos. So it makes sense to do things like lock in a competitive fixed rate on a mortgage. If you can afford the fixed rate, then you can go to bed every night knowing you can pay it. Yes, it may not be as low as a variable rate, but with interest rates potentially heading upwards, it makes sense to fix the amount you're paying, in my view. And also check that you're not paying ridiculous amounts of money for things like unauthorized overdrafts, credit cards, personal loans, store cards, and the like. That's common sense at any point in time, but it makes sense to do it now as people are discussing the possibility of interest rate rises. Finally, don't panic. I've said this before. If you are running a portfolio that is well balanced, has enough emergency cash, if you like, is properly diversified and is not funded with debt, in other words, your personal balance sheet doesn't have expensive debt in it, then you should be in a good position to ride out any dip in the stock market. And don't forget that over the long term, stock markets tend to rise, and therefore if and when we hit a dip, if you can ride it out, you're likely to benefit from the long-term direction of stocks. Now, if you want to hear more on any of these topics, which I've covered pretty quickly, then please do go to my extensive library, killick.com/learn. And if you'd like a copy of my guide, my fairly basic guide, How to Invest in Equities, then please do ping me an email, editor@killick.com.